Now, guys, it's been a long-held belief that paying off your mortgage before going into retirement was the right thing to do, but is that really still the best strategy, given rising interest rates? What do you tell your clients these days?
I would say, in general, I think being debt free is the way to be in retirement
Sure.
time. I'd also say, my wife and I were on our third house, and we follow a lot of the advice that we give to our clients. In fact, my goal was to have our house paid off by the time our kids went to college, and it was 2 months ago now. And my wife and I paid off our house, so we don't have a mortgage. And
Awesome.
I know interest rates are really low. I mean, I could probably borrow against my house, and still, when you think about the potential of what you could make, even with rates rising, some people think that it's a good idea to have a mortgage and invest the money and do something different. And I would say, after 28 years of doing this, one of the consistent themes when I say, these clients are having a really good time enjoying life, they have the freedom and flexibility to go, is it's clients that don't have a mortgage, it's clients that are debt free, it's clients that are able to not have that monthly payment. Now, one of the things that I would caution you about is the decisions that you make are going to impact one thing, and it could impact another. As an example, people will oftentimes say, should I take a lump sum of money out of my IRA, 401k, or retirement account, and should I pay off the mortgage? When you look at it, let's say your mortgage payment's $1,500 a month, and the balance is not really large. You take it out, and it's going to free up a $1,500 a month cash flow. When you look at it from a cash flow perspective, one might say, yes, that makes a lot of sense.
Sure.
But the second area that they don't maybe sometimes take a look at is the impact that could have on things like your health insurance cost.
Right, absolutely, because that is reportable income at that point. When you pull that money out, that goes as reportable income, and depending on what your threshold is for income, that could change your monthly premium for your Medicare and or your your health insurance if you're under 65. So and that's why Nolan and I have known each other for a long time, and that's how we first became partners in crime, so to speak, and working together, is because we would help people maximize their premium tax credits with the Affordable Care Act, and utilize their reportable income to keep it as low as possible. So you have to pay attention to where's that money coming from.
You really do. It can have a pretty big impact. So imagine if you were on the Affordable Care Act, you're 62 years old, and then you took out a big lump sum of money to pay off your mortgage. And, conceptually, like I said, looking at the monthly payment makes a lot of sense. But all of a sudden, when you went to file your tax return, you found out you lost that tax credit. Now, all of a sudden, the government's going to ask you for a lot of your money back. That's one of the areas where, again, at the end of the day, I think being debt-free is kind of the goal to get to. But how you get there comes down to taking a comprehensive approach of kind of bringing it all together. If you look at the statistics that are out there, according to the Federal Reserve, nearly 38% of people between the ages of 65 and 74 have a mortgage or home equity line of credit on their primary residence in 2019. And that's, back when mortgage rates were a lot lower than they are today. Back in 1989, when the average mortgage rate was a whopping 10.32%, only 22% of people in that age bracket owned money on their primary residence. And so with, rising interest rates, if somebody has a, home equity line of credit, that is something where the interest rate is usually going to change, and those interest rates are going to go up. If we looked at a traditional 30-year fixed rate mortgage, last year it was at roughly 2.96%. This year, the Federal Reserve has raised interest rates. The average 30-year fixed mortgage soared from a low of that 3.45 in January to 6.11 in September. And that's a level that we haven't seen in mortgage rates since 2008. So if you have a mortgage on your house and you're thinking about, what do I do? Should I pay off the mortgage now that rates are going up? Should I just, stick it out? It's a 30-year mortgage. I'm never going to pay this house off. I'm better off leaving my money invested. These are all good topics of conversation to take a look at, and talking with a professional and running the numbers. In some of our software that we have, we can do is we can look at the probability of success. And so we can run the analysis that says, if you're taking out extra money out of your IRAs while you're using that to pay your mortgage payment, is it better to do it that way, or is it better to take the lump sum of money out? You do have to dive a little bit deeper into it. Again, this is an area where a lot of these things overlap. So for the most part, the stock and bond market has had a pretty challenging year for 2022. So if you're thinking, well, I'll just pay off my mortgage because all I'm doing is losing money in the stock market, by selling, what you're actually doing is you're physically locking in your losses, then giving yourself no chance to get back. Because I have heard people say, Nolan, all I do when I look at my investment statements is lose money, so I might as well take money out of my 401k or IRA or retirement account and just pay off my mortgage.
Sure.
Again, it may or may not be the right thing to do in your own situation. Conceptually, let's develop a debt elimination plan. Let's look at ways to pay off debts. Let's not, put that extra stress of all those payments together, but let's do it in a way that makes a lot of sense. One other quick story, I know we're coming up on a break, is we recently had the same situation for somebody that came into the office. And what we did is we took a lump sum of money out this year, so it fell on this year's taxes, and then we're going to take some more money in January, so it shows up and it stretches it out over 2 tax years. There again is a good idea why to talk with an accountant, have somebody looking at it from a tax perspective, so you're making decisions that, are looking at it from healthcare, from taxes, from investments. And by doing that, it's going to give you the ability to make the decision on, what could be the best approach for you when you're looking at that question, should I pay off my mortgage before retirement?
Obviously, there is a very strong argument to be made about being debt-free as you enter into retirement, but at what cost? Make sure that you run the numbers and that you do it properly. You don't cut off your nose to, spite your face in this situation. And the team at America's Retirement Headquarters, they can help you run those numbers and show you the best way to go about it, the most methodical way to go about it. When Nolan and Scott said, when Scott said partners in crime earlier, not literal crime. Just want to go ahead and get that disclosure out there.
Right.
Just want to make sure everything's on the level to get started and see. Give a call, 419-794-3030. Or you can go online to americasretirementheadquarters.com.